one thing we probably need to come back to is depreciation. So
Okay.
I've had a couple of guests on the show. So if someone's listening to this, they've heard it before. You can fast forward through this section, but essentially, Brady, my question is, in your words, how you describe depreciation to someone who's never heard that?
So, first and foremost, we have to differentiate the depreciation that we are talking about from the depreciation that most individuals are familiar with, which means a decrease in value, the opposite of appreciation. Well, in accounting, we use the word depreciation to define what's referred to as a cost recovery or a cost allocation, which really means when I purchase an asset, I can recover the cost of that asset over a period of time. In some instances, I can recover the cost of that asset in 1 year. And in other instances, I would recover it over a period of time that or rather the IRS has deemed that asset to be quote unquote useful. So that hopefully that helps and is kind of simplified to help people understand that when I go buy an asset, I can recover the cost of that asset over a period of time that asset is going to last me.
Okay. So let's talk about maybe let's give an example. Let's say you buy a $500,000 rental house.
Yeah.
So, the land is never going to depreciate, right? So land value will take out. So let's say the house is worth, and okay, let's back up even a little further. What is the standard split? There's a percentage of land versus the house, correct? Or is it sort of the assessed value?
Yeah, typically we try and use assessed value if we can, because it's a little bit more fixed and secure rather than just making an assumption. We want to be able to use some sort of data to back that up if we ever needed to in an examination with the IRS. So I'm actually, instead of using a rental property, if you're okay with this, Eric, I'm going to use like a vehicle because it's just a little bit easier to understand and then build into the rental property. Let's just say I buy a vehicle for $50,000. Okay. Now the IRS, they typically deem a vehicle to have a useful life of about 5 years, which theoretically means that I'm going to deduct $10,000 every year for 5 years to recover the cost of that asset. Plus, if I'm in a business, I can deduct the interest on the loan that I purchase, right? So this gives business owners a great opportunity to write off the cost of those assets, right? Like I mentioned before, there are some opportunities that individuals might have to write the expense of that asset off quicker using what's called bonus depreciation. So you might get a bigger expense in year one, even though you didn't spend $50,000, you still might get an expense for $50,000, right? Which provides a great opportunity for some tax planning. Now, moving into the rental property, I utilize the depreciation in the same manner. However, the asset life sometimes changes, right? Because theoretically, a piece of property, especially as it relates to the foundations, the footings, those should last 27 and a half years, which is the useful life for a piece of residential real estate, or 39 years for a piece of commercial real estate. Again, those asset lives are determined by the IRS. And I take whatever the cost of the asset is, like in your example, $500,000, less the cost of the land. And in just general terms, divide that cost by the allotted time period of 27 and a half or 39 years. In theory, that's kind of how that works.
Okay. So let's take this example again. So $500,000 single family home. Let's say the house itself is worth 300. So we're gonna depreciate $300,000 over a 27 and a half year period.
Mm-hmm.
So it's just basically more or less going down in value, kind of as far as like this example goes, which we know isn't the case, but that's how the tax code is. Correct. So then you sell, let's say 10 years later, let's say just loose math, it's depreciated roughly a third of that life, right? So let's say it's gone down 100 grand. So let's say it's worth, at least depreciated down to $200,000 just for simple numbers. Yeah. Then you sell it. How much of that do you have to recapture? I mean, like how much do you have to pay back of that sale? So let's maybe walk through this example. This is perfect. Yeah. You sell that property, it's depreciated 100 grand. What does your taxes look like in that scenario?
Okay, really good question. So I'm going to back up just 2 or 3 steps if you don't mind. So When I utilize a depreciation expense, I'm getting a tax benefit because I'm able to deduct the cost of that depreciation in year one or year two, three, four, five, etc. So using this example, let's say after 10 years, let's say my depreciation expense is roughly $10,000. That would roughly be $100,000, give or take, after 10 years that I have depreciated. And because I've received the tax benefit of that depreciation currently, that depreciation deduction or the accumulated depreciation that I have taken reduces my basis or what I have quote unquote paid for the property on paper for when I go to sell it. Okay. So this is a really good key, and you use the word recapture. Understand that recapture just means that now I've got to pay the tax on the difference or my adjusted basis in the property based on how much depreciation I've taken. So there's a couple of different ways that this might work. If I have sold the property outright in a one-time transaction, that adjusted basis is factored in, and now I just might have a potentially larger capital gain on my property because I have a lower basis in the property. So my capital gains is going to be a little bit higher. Now, if I've done maybe if I do a seller finance transaction, a seller finance transaction might still be beneficial because I can elongate the amount of time that I have to pay a capital gains tax. However, if I have claimed depreciation, I do have to pay that recapture in the first year. I do have to report that and pay it in a seller finance deal. Okay. However, this is where we were kind of talking about the 1031 exchange. Maybe I take this property and I trade it for another property of equal to greater value. And then at this point, I don't have to pay the capital gains tax on that property, even if I have depreciated the property and have an adjusted basis. I don't have to pay recapture because I've exchanged it all for another property.
God, I have so many questions. Like we could just go super deep into this. But let's finish out this example. Actually, this is a really good one to finish out. So let's say you have this $500,000 property, you depreciate it down to 400. Let's say you sell it for $1 million, just as an example, right? So you make $500,000 in what would be a difference in what you paid and what you sold. However, you've depreciated it down, so your basis is now at 400. So the capital gains look at it is you have this $400,000, exactly, asset more or less, as far as the IRS is concerned, sold for $1 million. So $600,000 kind of taxable income is what we're looking at in this case. So, for like kind of loose round numbers, you could say, let's say 15% is a capital gains number that is fairly common for long-term capital gains. You might pay 15% of that difference. So maybe in this case, $15,000 of a tax hit, but over the last 10 years, you got to depreciate 100,000. So it just seems like, again, it's just sort of one more benefit. And hopefully that example helps people like wrap their head around what all of this means.
Yeah, I would say, so the average tax rate in America is roughly 22 to 24%. So if you're getting a deduction of $10,000 every year at 22 to 24%, that's $2,400 in tax savings. Over 10 years, that's $24,000 in tax savings. So there's kind of rough math on those numbers. Now, if you have a capital gains tax of $600,000, you're now in a long-term capital gains tax rate of 20%. So 20% of $600,000 is now $120,000, but I've already got $24,000 in tax savings over the course of the past, 10 years. Really, my total net tax would come out to be right around $96,000 because of the difference between what I've already saved and what I might do later on. So that those are kind of some numbers to throw around.